Hi, good morning. Thank you for joining us today. My name is Sarah Campbell, and I'm going to introduce our presenter and just point out a few things to you really quickly. Thanks for joining us today for year-end procedures. This is part one of a two-part series on end-of-year procedures, and if you look in the Q&A section, you'll see that there are links to register for the second part, which is taking the scare out of 1099s. If you use that link, you can also read more about what that webinar will be about. I've also posted a link to sign up for our monthly email newsletter, which will include things like latest accounting news, updates, announcements about our upcoming events and webinars, things like that. I'll go ahead and introduce our presenter now. Her name is Amanda Moon. Amanda has been at Squire for 5 years as part of the advisory department. She specializes in outsourced controller work and has worked with numerous clients in various industries. Amanda loves solving client problems related to QuickBooks and payroll. One of her passions is digging through data to find the anomalies. Amanda is one of our top specialists in combined year-end and payroll reporting. So I will go ahead and pass it over to you, Amanda.
All right, thanks so much. Welcome, everyone. This class is about the year-end procedures that you need to do to get ready for your tax return, and so hopefully that's what you all came here for. The things that we're going to be talking about today are the tasks that all businesses should do to prepare for filing taxes, and then things to do specifically if you have employees. And then we're also just going to touch on what to do if you have subcontractors. So the first topic is things everybody should do to prepare for filing their taxes. So starting just at the top of the balance sheet, the first thing that I would typically look at is your cash balances. So you want to make sure that you've recorded any transactions for money received or paid outside of your bank accounts, because we don't all just use our checking and credit card accounts anymore. We have PayPal accounts, we have Venmo, and then sometimes you have a petty cash account that you use, and so you want to make sure that that is that the amount that you have on your balance sheet matches what you actually do have in your petty cash drawer. And so for your Venmo, you can get your activity and get that entered and make sure that any expenses or income that you have on there is reflected in your accounting system. And the next thing you're going to do is look at your most recent bank reconciliation and review the uncleared transactions. So if you have got checks from 2017 that haven't cleared, they're probably not going to. So this is a good time to review those and decide, why are they still outstanding? Is it a check that you need to reissue to someone? If it was a paycheck and someone didn't cash, and it was maybe something that you knew they lost, so you recreated that check for them, we can look at what's the best way to clear that off. If you have checks to vendors, if it's just a check, that's a little easier. If it's a bill payment, that requires some extra handling. You'd never want to delete a transaction that happened in a prior year, because that transaction has already been included on your tax return. So the expense for checks that you had in 2017 were claimed on your 2017 taxes. So we reverse those using journal entries, which I know that no one loves a journal entry except for an accountant, but I think it's the best way to handle those. So you also want to make sure that you are aware of and compliant with unclaimed property laws. So that's why you want to look at each transaction. If you have a check to a vendor that they haven't cashed since 2015 and you're still doing business with them, most likely you paid them that in another way. Like they sent you a new bill that included a balance due amount on it, and you made the payment for the entire amount on there, but check with your vendor. And if you don't in fact owe that, then we can void that with a journal entry. If you have paychecks, again, sometimes people just won't cash really small paychecks, but check with the employer, check at your history and see if that's something that you have redone before you get rid of that. And then on paycheck, it makes it a little tricky because that was reported as income to them on their W-2. So if it's a current employee and it's something that you did actually repay them and you repaid it through payroll, then you'll need to do an adjustment to adjust down their payroll this year so that they haven't been taxed twice on it. A lot of times though, if someone loses a check and it's a paycheck, we'll just write a check for that amount. And so you can do your void reversal using whatever expense account you used for the replacement check outside of payroll. Excuse me, any transactions that haven't cleared that you verified are not in fact owed to the payee. If it's just a check, it's easy enough to reverse those because you can use the same expense account. If you find out though that they are owed the money, when you track it down, you can't find a duplicate and it doesn't look like it was included in any other transaction, and it wasn't just something that was paid as a deposit meant to be destroyed once you were done, then you'll need to reissue that check. So, or otherwise turn that money over to the state for unclaimed property. And then do your bank reconciliations. I just can't stress enough that this is the biggest tool that we have for finding, or one of the biggest tools we have for finding problems for the year, because when you do your bank reconciliations, what you're going to find is, again, those uncleared transactions. You might find deposits that haven't cleared, and a deposit should always clear unless you've done it on the last day of the month and maybe your bank didn't credit it until the next day, or you recorded it on the 31st but actually didn't make it to the bank until the 1st. So for those, if you have a deposit that was recorded but it hasn't cleared the bank and it's from 6 months ago, there's likely an issue. What happens sometimes is that we record a deposit from payments, but then we add our deposits from the bank feed instead of matching them. And so they're in there twice. So we clear one and the other one just kind of hangs out on your statement. So you're duplicating your revenue. You've recorded it when you recorded the sales receipt or an invoice that you paid on as income when you add it from your bank feeds. And at tax time, you definitely don't want to have double counted income, right? So it's a good time to go through those and check those off. And that brings me to one of the deposited funds. If you go into your accounting system and go to make a deposit, you should not see any checks or payments waiting to be deposited unless you truly just got them. If you don't, that pending credit card payment or that check shoved in or some cash in the cash drawer that you need to take to the bank, then what happens a lot is that we receive a payment from a client and then again add those deposits from the bank feed instead of making a deposit from the funds that were recorded as received. So they sit out in undeposited funds, and sometimes these stack up and we're talking thousands of dollars that you don't have. Undeposited funds should represent the money that you have shoved in your drawer or wherever you keep payments that probably you're all more organized than that, but wherever you keep your payments before you actually take them to the bank. And so if you go into your deposit screen and you see amounts that you don't in fact have, it's time to put on your detective hat and investigate what happened. Were they deposited earlier and recorded again as income, or if it was cash and you're the owner, did you use that money for something else? Then you'll want to record that money to petty cash, and then whatever you spent the money on, you'll want to capture those expenses out of the petty cash as well, or show it as a distribution if you took it home to go out to dinner that night. Whatever the case may be, you want to make sure that you have the undeposited funds reflects funds that you truly have that just haven't yet been deposited. So the next item we have is long-term liabilities, and really short-term liabilities too. You may have some short-term loans. So you want to reconcile your liability accounts with either a year-end statement from the lender. That's so preferable. If the bank gives you a statement and says, this is how much is left on your own loan, this is how much you've paid in interest, and maybe there were some fees in there as well, you can reconcile that. Otherwise, we keep amortization schedules a lot of time, and you may have that as well. So you can look and see what month you're on and what your balance should be, and if you've made the same number of payments that that amortization schedule says that you've made, then you can pretty well match up what your balance should be. And a lot of times what we do is you get in a hurry and you're recording your payments to your loan, and it all goes in against the loan balance in your books. And in reality, though, that's not all chipping away at your balance. Some, or a good chunk of it, is going to be interest, depending on the type of loan and the interest rate you have. So unfortunately, what we have at the end of the year, before this adjustment is done, is that your liability balance is understated. It shows that you owe less than you actually do, because all those payments have been applied in your accounting system to the principal. And then your interest expense is understated because you haven't been recording the portion of that that goes to interest expense, and then sometimes fees as well. So you'll want to make sure that you do that reconciliation, that your liability is reflected correctly, and you're capturing that interest expense, because after all, we want to get those expenses into the system accurately for our tax return. And then if you have related party notes, those typically you need to accrue interest on those. So it's a nominal interest rate that you're going to use. Make sure that you have that interest recorded as well. And these are tasks that if you aren't comfortable doing, want some help with, that's something that we can help you with. Then your accounts receivable and accounts payable. Pull a receivable aging summary and a payable aging summary and go through the list. And if you see negative amounts, do you owe that client money? Do they have a credit, or do they overpay and you're planning on applying it to their next invoice? And if they do, are the people who take payments aware of that, so they know next time that person goes to make a payment, they can say, hey, you have a credit on here of $24.63, so pay that much less, and then we'll get your account cleared out. Otherwise, you may owe a refund check to customers. And if you have, a lot of times we do see payments in there that haven't actually been applied to an invoice. So while a customer has a zero balance, they have maybe negative $1,800 in the, or sorry, they have $1,800 in the over 90 days, but then they have a negative $1,800 that's in, say, 60 days because that payment hasn't been matched to the invoice. So you may have some cleanup to do there as well. And if you see old amounts on there that you say, you know, this is 3 cents, I'm certainly not going to write this person a check for 3 cents. They haven't been a customer for 4 years. This has just been hanging on here. Then you can make some adjustments to that. If you have bad debt on there, if you look at that and see that you have balances that you've been carrying for years and you realize it's not collectible, then the end of a year is a good time to write off that bad debt. And then the same with your accounts payable. If you see negative amounts, does that vendor owe you money? Do you have a credit with the vendor that you haven't paid? Do you need to short pay your next invoice and then talk to the vendor and say, hey, I have this credit from, you know, 2019, I'll use it to apply to my next invoice, because they don't always apply those if you don't specifically let them know. Or they gave you a credit and what happened was the next time they sent you a bill, they reduced it by the amount of that credit, and which is great, but the best way to enter that bill would be to enter it as the amount that it was before the credit was applied, and then in your accounting system apply that credit. But that doesn't always happen. We enter those bills a lot of times for the adjusted amount, so then that credit's still sitting there. So it's a good time to review that and just see where you stand on each of those. And then item receipts that could be double entered. Sometimes we have bills that are entered and then it also gets entered as an expense. So when it's paid with, say, a credit card instead of paid off of the invoice. So some of those items that are outstanding on your accounts payable aren't actually outstanding. So then a couple other reports, if you're in QuickBooks, that might be useful to you are the open invoices report and unpaid bills detail, as a way of just drilling down on those transactions and seeing that it's reflective of what your current situation actually is. Then the next section we want to take a look at is our inventory. If you carry inventory, you are aware and probably in the habit of taking a physical inventory count at the end of the year. If you sell online and you use something like Fulfillment by Amazon, or you have your stuff in a warehouse that someone else is doing the shipping and taking the inventory for you, then this just means they're going to give you that inventory count, and they may have a perpetual inventory and then take an inventory count once a year or once a month, whatever the case may be, whether you're doing the inventory count yourself or the person who has physical possession of the goods is doing the inventory. Either way, you need to do a inventory count at the end of the year. And be sure to take into account if you have any inventory in transit at the end of the year. And if you do, do you take possession of that as soon as it's shipped or not until it's received? And that will determine whether or not that needs to be included in your inventory count. Reconcile your actual count with your inventory tracking system and make any adjustments that are needed. And that can be to the quantity, but also if something has, since you purchased it, has become obsolete or is really, you can only sell it at a clearance amount, you're going to adjust the value down and take that adjustment loss on that if the market cost is, or the market value is less than what your cost on that item was. And then compare your inventory valuation report with your balance sheet. They don't always match because sometimes journal entries or other entries get made that hit inventory as a balance sheet, but they don't actually hit your inventory count on an item basis. So if you have any differences there, it's again time to put on your detective hat and find out what happened and get those to match. The next section is equipment purchases. and we've got a picture of a crane here, but equipment can be anything from heavy equipment to office equipment, medical equipment, furniture, or vehicles that you may have purchased during the tax year. Maybe you are doing really well and you got an airplane. I don't know, but those are going to be all fixed assets that you want to double check and make sure that you have recorded on your asset list. So you're going to make a list on anything that you bought during the year. And we put on here the things that you want to include. It's obvious, the date of purchase, the purchase price, the vendor, what type of asset it was, so we can put it in the right bucket. And identifying information, because later on, if you've got 6 GMC Sierras and you trade one in on another one, you want to make sure that you can identify which one left and which one came in, so that when you are calculating the gain or loss on the sale of that equipment, that you're using the right one that you released. And then whether it was new or used, because of course that affects the tax treatment. And then how did you pay for it? Did you get a loan? Did you pay cash? Did you put it on down payment and then get a loan? Did you have a trade-in and a down payment and get a loan? Whatever the case might be on that, make a note on your list of how it was paid for or financed. And then if it was financed, what the terms were. And then also review your list of equipment from the prior year to have anything that was sold or scrapped. Do you have a piece of equipment that died and it couldn't be scrapped, so it was just tossed? Or do you have something, do you have a car that you sold to get the new one? Or whatever the case might be, we want to make sure that what we have matches. And that goes not only for making sure that your list of assets on your tax return is correct and that we're depreciating it appropriately, but also come early next year, I think it's about March that you get the notice, and May when you pay your property taxes on your personal property, you'll have this list ready for you and be able to make a good start on doing what you need to do for your property tax next year. The next section we have is your equity accounts. I mentioned this before, but do you have any personal expenses or draws that should be coded to distributions? Because if you're the owner, it happens. Sometimes you use that card for dinner with the family or your vacation or whatever, because you're keeping your points in one place. But we need to make sure then, if that is personal, that we are coding it that way, so it's not counting as a business expense and it is counted as a draw. Or if you took money out of your own business, that's fine. We just need to make sure it's coded correctly as a distribution. But we also sometimes have expenses that you pay out of pocket, especially this year. It was a tough year, and a lot of businesses had cash flow issues in the businesses, so they were pulling on other sources to be able to meet the expenses that they needed to do for their business. So if you had expenses that you paid for out of pocket, make sure that you record that so that you're capturing that expense on your business return, and it just gets entered as a contribution when you've paid for something out of your own funds instead of the business. Okay, year-end adjustments. This says, of course, at the top, tasks everyone should do. Maybe not everyone needs to do these, but it depends on your business. If you have those fixed assets, the equipment or vehicles, then you need to look at your depreciation or amortization. Amortization would be anything that's intangible. So maybe you had someone build you custom software and it cost $15,000. And so that is going to count as an asset to your company, and then it gets amortized over 3 years. Or maybe you had loan origination fees that are significant enough to amortize. So look at those, and if you haven't been recording a monthly or quarterly, that's fine. Then we just will do an annual entry. And some people use their tax depreciation for their book, which means you record in your accounting system just the depreciation that matches exactly on your taxes. But other people don't use that. They have a book depreciation and they look at the useful life of that and depreciate it differently. And we keep 2 depreciation schedules, and that's just fine. Either way, make sure that you are recording your depreciation and amortization for the year. And that's something that your accountant can help you with. Prepaid expenses. Now, it says at the bottom, I'm assuming accrual basis. A lot of you will be on cash basis and it won't apply. But if you're on accrual basis and you have prepaid expenses, if you have deposits that you've made, or if you have paid for your entire year of insurance in December, but it's for 2021, then that is a prepaid expense, and then it would become an asset to your company, and then over time next year you would expense that. If you have it all booked as a year as an expense for this year, then you've really overstated your expenses. And it does make a difference if you're accrual basis. Customer deposits. Have customers prepaid for work that you're going to perform next year? This actually, if you're on accrual basis, you don't want that to count as revenue because you haven't performed the work. So it's going to be a liability to you until you actually perform the work, because you do owe them that service or item. So you don't want to overstate your revenue if it's something that won't be fulfilled until next year. And with COVID too, we see things that have had to be canceled or postponed that won't happen until next year. So that's something that you may have to look at this year that you haven't done previously. If you have accrued payroll or liabilities, if you owe money for work or for products and you haven't received a bill yet, you can have an understated expense. So take a look at that as well. Now, I talked about reconciliations being just one of your best tools. The other thing I would say that's in that category is reviewing your financial statements comparative to prior years. So pull a balance sheet and a profit and loss and check the box that says that you want to compare to the prior year. And just start at the top and look at every line item. And the first thing you're going to do is what we like to call the smell test. Does it look reasonable or does it look a little off? If your change on that item is due to the downturn this year, then that is reasonable. But if last year you had a $10,000 expense and this year you had $150,000, are you missing an expense? Is there something that you didn't capture? Or did you record it in a different expense category? Maybe you have some duplicate accounts. So, and sometimes people will change their chart of accounts or the way they record things, and that's okay. This isn't necessarily an exercise to slap yourself on the wrist. It's to just really look at those and see if there are changes from year to year. Do they make sense? Is it explainable? Is there a reason that you had a large expense last year and didn't have it this year, or vice versa? It's a new expense line item for the year and you didn't have it last year. Is it something that was recorded in a different insurance account than the prior year, or a different, equipment, whatever it might be? Just look and make sure that those year-over-year differences are reasonable. And if you have anything missing, so that's again when you have an expense that you had last year and you don't have this year, then maybe that's something that was paid for out of pocket or got recorded under the wrong account. So it's a good opportunity to go in and dig in and see what might be off there. And then same with your balance sheet, looking at year to year if it looks reasonable. If your loan balance is exactly the same as last year, that's not reasonable. Either it got recorded to an expense account. Sometimes I see car payments get recorded as auto expense instead of bringing down that loan. So you want to make sure that those balances look right and are where they should be, and that you don't have negative amounts, because it's really rare to have a negative credit card balance unless you are on auto pay and then you accidentally also send a check. Then maybe that could happen, or you return something at the end of the year leaving you with a negative balance. Otherwise, that negative balance is not right. Something's wrong. So we need to dig down and make sure that everything was recorded. Maybe the payment got recorded, but the expenses haven't been put in yet. And the same thing with other loan accounts, or if you have, again, a large undeposited funds amount, or it looks like you have a lot of money in one of your cash balances that you know isn't there. So just look and make sure that that is reasonable and that it can be explained. If sometimes we do have things on there that are old accounts that maybe should have been adjusted off. So just take a look at that and see if there's anything missing as well. And then if you're in QuickBooks, something you definitely want to do is close your books. It doesn't require you to close your books, so you can edit things, you know, from 2002 if you want to, but that's a bad idea. So if you close your books, it means that you can't change something from a prior period that you've already reported on your tax return without putting in a password. So you can't do that by mistake, or just someone who's working for you doing it just because they don't know any better. They're voiding a check, but we can't void a check from a previous year. So, and then if a change is needed, you can put in a password, but make it a password that not everybody has, because you want to think twice before you make changes to a closed period. And then you set a closing date to tell it how far back you want to go. So some people will set it for the end of the prior year. Some people will close it every month as soon as they've reconciled. So that's personal preference. So the next section we have is tasks to do if you have employees. And we are talking about W-2 employees here. So you want to pull payroll reports by quarter, so you can do a year-end payroll reconciliation and make sure that the balance on your balance sheet for each quarter, too, pull a balance sheet by quarter, and make sure that the balance on each quarter is equal to the amount that was either paid or adjusted in the next quarter. So the exception is federal unemployment. You don't have to pay that until it reaches $500 or the end of the year. So first quarter, maybe you only racked up unemployment of $84 because you only had 2 employees. Well, you're going to keep that $84 balance probably until sometime in January when you make that payment. So, but the other ones, that should be equal to what's adjusted off next year. Otherwise, it has an error. So it'll help you catch any errors that you might have, so you can adjust it in the fourth quarter filings instead of having to amend reports. What happens sometimes is when it is off by a few cents for rounding, we record that liability payment through QuickBooks for the full amount of what QuickBooks tells us that we owe, but then it comes in from the bank for a few cents difference, so it gets added from the bank feed as either being a payroll tax expense or hitting the liability account. So then your liability account now has 2 payments that have come out of it, so you end up with a negative balance. And you have one that has never cleared on the bank reconciliation, the one that was paid through the QuickBooks payroll system, and the one from the bank did clear, when the correct thing to do would be to record the liability payment through QuickBooks for the actual amount that was paid and then do a payroll liability adjustment for whatever the rounding difference is. So we either see this for a few, the unemployment, we do update QuickBooks with our new unemployment rate at the beginning of the year. So it's been calculating your state unemployment at a different rate than is actually being charged by the state. So we'll get to that in a minute, but make sure that when you get that letter from the state that you go in and update your rate right away so that you don't forget and have this kind of mess on your hands of having to adjust that later. And then your 4 quarters reports totaled together should tie your totals on your W-3 and your state forms. That's something that you won't really see until January because they don't even have the new forms ready and available for you to, in the accounting software, for you to double check. And you want to see also if you have any payroll liabilities that you need to move over with a journal entry to offset an expense. This is when you have health insurance or an HSA, or sometimes we have garnishments. And so they've been taken out via payroll liability from someone's paycheck. And then in some versions of QuickBooks, so on online and in a lot of other accounting systems, you can't set that payroll item like an employee's health insurance to hit an expense account. It would be because it comes in then as a negative expense. You can do that in QuickBooks Desktop, and I really like that, but you can't in the others. So it goes in as a liability. So then you have either the direct payment to Select Health or Health Equity coming out of your checking account, or you write a check and you hit an expense account with that. And then, so you have overstated your expense because not all of that expense belongs to the company. Some of that expense is the employees who paid it out of their paycheck. So you've that's a split expense. So you need to do a journal entry to debit the liability and credit an expense. So again, it comes in as a negative expense to offset the expense that you had recorded as a company, so that you're not overstating your expenses and you don't have a liability sitting on your balance sheet that you do not in fact owe because you've paid health equity. So that's something that we can definitely help you with. We do a lot of that cleanup at the end of the year. Some people do it monthly, so that's up to you how you want to handle that, but you'll want to make sure that those payroll liabilities on your balance sheet reflect what the actual liability is, of course. And then fringe benefits. That would be compensation other than wages that you provide to an employee, and they can be taxable or non-taxable. So if you're an S Corp and you have officers' health insurance or group term life insurance, employer provided vehicles, if you aren't including that every payroll run, then the end of the year is the time that you would do it. So most payroll processors have a special type of payroll that they can run to do an end of year. You figure out how much their employer provided vehicle use was, or group term life insurance that you paid on their behalf, or S Corp health insurance that wasn't recorded on their paychecks already. And then they can do a special payroll at the end of the year to record these fringe benefits. So it gets included on the W-2, and they do owe tax on it. So if you haven't already paid the tax on it, a lot of companies will then gross up the payroll on that final payroll to do the fringe benefits by enough to cover the taxes. So it increases their W-2 wages even more, but then they're not having to cough up their half of the Social Security and Medicare. Typically on these, you wouldn't do withholding on them. And let's see, or you can, if you are doing the W-2s yourself, you can manually add those to the W-2. It's I prefer to do it through payroll so that it's then already bleeds through onto all your payroll reporting forms, and you don't have to manually then adjust your 941 and your TC 941 and all of those. It's just on there, but you can just manually adjust it as well if you like to do that. If you're in QuickBooks, and again, I know not everyone is, but if you're in QuickBooks Desktop, make sure that you update your software and your payroll. And I'm not talking about going from 2019 to 2021, which is the current version right now. I'm talking about, say, release 7 to release 8. So if your QuickBooks, when you open it up, prompts you and says, there is an update to your QuickBooks software, would you like to update it now? Say yes, and it's going to happen frequently throughout January for both the software. You probably saw it a lot in April as they had to make updates to accommodate the new payroll filing forms for all the CARES Act items. Make sure you're updating your software and then also applying the payroll updates as well. And in January, it can happen almost daily. And I know it's annoying, but take the time to do that, because when you then are ready to pull those forms to file, you want to have the most recent information available to that. And then, like I said, if you've gotten your letter, oh, I forgot to change the year in here, you guys, from last year, I'm sorry. So this should say 2021. If you've got your letter saying what your new unemployment rate is, go ahead and put that in and change it for 2021, because there is a place in there for you to say, this is this year's rate and here's next year's rate. So you can go ahead and already plug that in. And HSA, I know that limit changed. It was $7,100 for this year. Next year it's $7,200. So when you have that payroll item in your accounting system, one of the things that it asks you when setting that up is, what is the limit? And so you'll want to, in January, change that so that it shows the new $7,200. And I'm not sure if the 401k has updated for 2021, but keep an eye on that and update that as needed. And then I know some people have insurance years that change mid-year, but some people are January to December. So whatever the health insurance amounts are for your employees' premiums, make sure you get that updated as soon as you run your final payroll in December, so that when you do your January payroll, that you're pulling the correct amounts. Excuse me. So the payroll forms, if you're not the one that typically does those, just a note that those are due January 31st for federal and state, and that includes your 941 and your 940, and federal and state, or sorry, your state withholding and unemployment, and some states have additional taxes as well that you have to do at the end of the year when you do your payroll tax filings. So just be aware that deadline's coming up. For W-2s, if you haven't already used E-Verify to confirm that the Social Security number is entered correctly in your system, this is the time to do it. Because the IRS is looking back to 2015, there's a fine of $50 to $270 per employee if there's a mismatch. And if you're talking about a previous year, it's the $270, because this is a sliding scale based on when it was due. So your W-2s are due on January 31st. Again, if you have any fringe benefits, get that put in before you do your W-2s, and make sure that that is right. And if you've got your payroll system updated, it will have the latest forms. I do not think that the forms for 2020 are out yet. I got this screenshot from the IRS website, this little snip. So they may have them, but they may not have the electronic versions pushed out to the payroll providers yet. So, and then the last thing we're going to cover is what to do if you use subcontractors. And I'm not really going to cover this, we're just going to touch on it. This is just a reminder that it's 1099 time. So these are going to be covered in a separate class, and that is in the announcements for the meeting. So you can check that, and there should be a link for you to register. And this year is always important, but this year, whoa, I'm backwards. It's so key because there are substantial changes to the 1099s this year. So really make sure that you make time to attend that 1099 class. So they separated out the non-employee compensation. That form is still due on January 31st, and that is whether you're filing by paper or e-filing. And the other 1099s, not just miscellaneous, whether it's interest, if you have interest on shareholder loans or some other type of loans that you have, or if you have royalties, those types of things. So you want to make sure, I guess that's on the miscellaneous, but you want to make sure that you're aware of those deadlines. It's the end of February for paper and the end of March for e-file. So be aware of those deadlines. And this is a good time of year to review your vendors. Make sure if it is a vendor that should get a 1099 that they are marked that way in QuickBooks or in your accounting software as a 1099 vendor, and make sure you have those W-9s. If you don't, then start contacting your vendors who are 1099 eligible and get a W-9 from them. And it's a good practice going forward to get those up front and let people know that you can't pay them until you have a W-9. That eliminates a lot of the hassle of scrambling to get those W-9s in January. So start thinking about that now. That's everything that I have prepared. Do we have any questions for me?
Sometimes, Amanda, it takes a little bit of a, there's an echo for some reason. Oh, Amanda, can you mute yourself for a second?
Yes.
Thanks, that's where the echo was coming from. Sometimes there's a little bit of a delay between what we're saying versus what attendees hear. So we'll give them just a couple minutes here to submit any questions they might have before we wrap up. In the meantime, I'll just remind everybody, Amanda just said this, but in the Q&A published section, you'll see some links, one of which is so that you can register for next week's webinar on taking the scare out of 1099s, which Amanda just kind of touched on a little bit. And again, there's links to join our monthly email newsletter, as well as our handles on social media in case you'd like to follow us there. And it looks like we just had a question come in, Amanda. It asks, are education reimbursement programs considered fringe benefits? And don't forget to unmute yourself.
Thank you. I haven't worked with that. I believe that they are, but I would need to double check that.
Okay, so if we find out more information there, we'll email that with the slides and recording later. It looks like that is the only question, so we can go ahead and wrap it up. Thank you, Amanda, for your time, and thanks to all those who've joined us. Hopefully we'll see you next week for taking the scare out of 1099s.
All right. Thank you.
Thank you.